Good morning. It's July 1st, 2024. Welcome to America's First Investment Outlook podcast. I'm Dan Liu, Chief Investment Officer and Portfolio Manager. And joining me today is Michael Cheah, Head of Fixed Income and Portfolio Manager. So welcome to July, Mike.
Hello.
All right, just showing our standard disclaimer. You could read it here. We're not giving any investment advice or recommendations. We're just giving our investment outlook podcast thoughts and just a review of what happened last week and our thoughts about what's coming up ahead. So for the week, the last week ending June 28th, last week of the second quarter, the Dow was down 74 basis points. S&P and NASDAQ 100 and Russell 2000 were up, and numbers are shown there. Large cap growth continued to be the strongest performer in terms of style. Value continued to lag. International stocks were up 49 basis points. Yields backed up, and the iShares Core U.S. Aggregate Bond Index was down 71 basis points. For the quarter, which is the third column over, you can see that dominance was seen in NASDAQ and NASDAQ 100, and also the 1000 growth. Turning to the 10-year Treasury yield last week, the 10-year Treasury ended at 4.36%, rising 9 basis points from the week before. And for the year to date, interest rates are up 48 basis points. And as we know, the big story last week was the presidential debate, which was a shocker and eye-opener for many people. It's clear that Donald Trump had won the debate, but it was also sad that Biden's mental and physical deterioration was quite apparent and for the whole world to see. So the news headlines pretty much after that and during the weekend was Democrats calling for a replacement for Biden for the upcoming election. However, there's a lot of debate about whether or not that's feasible. Biden has clearly said that he wants to continue to run, even participating in a second debate in September. A lot of discussion about it. It's going to probably preoccupy the headlines for some time. Also want to point out that July 11th is coming up, which is the supposed sentencing date for Donald Trump after his felony conviction earlier last month. So a lot of unknowns, uncertainties ahead on the geopolitical front, but let's just turn it back to the markets. And with that, Mike, I'm going to let you talk about the economy, interest rate outlook, monetary policy. So take it away, Mike.
Okay. Thanks, Dan. Let's look at the economy. The next slide is from the Federal Reserve, and this is the Atlanta Fed GDP now. They update their with every indicator that is released, they will update their model, and the model is now forecasting GDP for second quarter running just below 3%, right? And this is of course above the blue chip consensus, right? However, despite this seemingly strength so far, if you look at other indicators, we are beginning to see some signs of a slowdown. Okay, next slide. And then next slide. Yeah. So you see this U.S. bankruptcy filings by year, right? The year to date through May is 275, matching last year. And so the question then is, how come with such a high rate of filing last year at 637, we are not seeing the impact on the economy yet, right? So what happened to all these businesses that have closed down and the losses that have incurred and the people that have been let go? And the question then is that will second half of this year data, right, matches or be worse than last year's data, right? Next slide.
Yeah, Mike, I wanted to point out that I have seen
Yeah.
that the credit spreads between investment grade and non-investment grade bonds has widened. So that's turning up. So I think we're seeing it in the credit spreads. Just want to point that out. All right.
Yeah. Yeah. So we're watching out for that canary in the coal mine, right? And this is very interesting. What you're seeing is that the black line before tax profit, right, in the real dollar terms, inflation adjusted, has been has gone up to a very high level. And in the past, when we have a high amount of profit, the blue line matches up. You have net domestic business investment as a percentage of final sales increases. But this time around, despite having a high profit, companies are not investing in this money, right? So perhaps this suggests a cautious uh, perspective from the CEO side, right? Next slide. Okay. Next, yes. And then we have the conference board data that came out. U.S. consumer confidence decline on weaker outlook for the economy, right? So here we are, forward-looking indicators are suggesting that things are not as well as the previously released data that we have seen, right? Next slide. And let's move on to inflation. And this model suggests that we might see a rebound in goods inflation. So this is rather interesting because the dollar has been very strong, right, recently. And usually a strong dollar would suggest a continued suppression of it. This model is suggesting that using the ISM manufacturing PMI, the sub-index, price index, which has been trending up, and that suggests that the CPI component for commodities, less food and energy, could be rising soon. So something that I'm sure the Federal Reserve is watching very closely. Right. Next slide. So as we turn to monetary policy, right, you see that using the data from this research company, on average, it's taken about 2 years for a recession to begin following the start of a Fed hike. Right? And if you look at 2008, it had taken 42 months, right? And then 1980 had taken 33 months. So what's my point here? My point is that we have been watching indicators that suggest inflation coming in, but because the inflation had been delayed, that led to some investors thinking that there's no inflation. Okay? Just because it's delayed, they think that there's no inflation. So this chart is a helpful reminder that sometimes it takes a longer while for monetary policy tightening to have an effect on the economy. So at 27 months, we are still within the range of expectation that inflation could come later. Right? And moving on to the next slide. Right? We talk about the bond market now, and this is interesting, right? Using data from the Federal Reserve, right, share of marketable treasury debt held by the Fed, foreign investors, and commercial banks have declined to 55%, right? So the question then is, who will step up to buy these bonds, right? And And the problem with this is that we rely on the institutional investors, we rely on the hedge fund, we rely on the retail investors to pick up the slack. The problem is that this class of investors tend to be very yield sensitive, meaning that they will buy this bond if you offer them a generous yield. So uh, we'll see with the yield where it is right now. Is it possible that yield will go up? And I would bet that the yield would go up simply because the deep pocket, the strongholders have moved out, or rather, they've been reducing their holdings, right?
Mhm.
And moving on to the next slide. And here, then, just to talk more about the bankruptcy, the dark line showed the Chapter 11 bankruptcy story count, and the blue line is the Bloomberg US corporate high yield average OAS. And we can, if you squint our eyes, we can see a slight pickup. Right. So the whole issue here is that given this increasing concern about bankruptcy, uh, my guess is that the yield spread should widen even more. Right? And so again, this is something that we're watching out very carefully. Right? Next slide. And this is the net percentage of domestic bank tightening standard for commercial and industrial loans to small firm. And you can see that the data still show that the banks are still willing to lend. Okay, so the question is, at what point will they tighten the standard? And you can see from the chart that the gray bars, right, the previous recession that we have seen came about when the commercial banks are tightening the lending standard. And when they tighten the lending standard, it is the high yield market that get sold off first. Right? Next slide. Now moving on to the dollar, right? You can see that this. Sorry, this is from Bank of America. I missed out on the citation. So they are suggesting that the dollar is going through this cycle. It can be 5 years, 6 years, 10 years, 6 years, 9 years, and the recent rally was 11 years. And they're suggesting that we have started the beginning of the decline in the trade rated dollar, right? So, well, if that's the case, then the opportunity could be in the emerging market. And when the dollar declines, that would also suggest that the foreign investors would not want to buy the U.S. Treasury bond market. Okay, so these are the things that we are watching very carefully for our investment outlook. Right? So that's what I have for you this week. Right?
Yeah. So Mike, I wanted to, I should have put a slide showing this, but a data point that I shared with you last week was the average amount of Treasury issuance during presidential administrations. If I recall the numbers correctly, under Bush, the average Treasury auctions was 1 trillion a quarter. Under Obama, it had risen to 2 trillion per quarter of Treasury issuance. Under Trump, that rose to 2.5 trillion per quarter. Now, under Biden, it's risen to between 5 to 7 trillion. So obviously, some of that's been inflated due to the pandemic and spending, but we haven't seen any significant reduction of spending, which unfortunately should lead to continued high Treasury bond issuance, which obviously leads to weaker auctions, higher interest rates, especially as you pointed out, if the traditional long-term institutional and government central bank buying doesn't occur. So, in my opinion, something's going to break, and it'll either be fiscal spending has to come down, which is unlikely right now in the election year. But I think afterwards we should probably, it's almost a necessity that fiscal spending should decline. Hopefully that comes along with a drop in inflation so that the Fed can lower rates. Because if that doesn't happen, you have high inflation, and recession usually leads to something we don't like called stagflation, which something to be on the lookout for, particularly next year as the presidential administration changes and obviously priorities change. Okay, so
Yeah.
um,
And
actually you had some comments on
stagflation hurt
energy.
both bonds.
Yeah.
Oh yes, there's one more. Just something to extra to monitor, and this is the brand short position, and as you can see from this chart, it is extremely crowded. So we know about the pain trade, right? The market will do whatever it takes to hurt the most number of people, and if we have a trigger, that could lead to a strong short covering in the oil market.
Mm-hmm.
Okay. And obviously, that's not good for inflation.
Okay. Well, hopefully that's not the case, and hopefully the shorts are
Yeah.
right this time. I did see some data that U.S. energy producers domestically produce oil that's risen to previous high levels of production. So in terms of the supply front, we do see domestic supply reaching historic high levels. So that definitely should support the short position. But as we know, oil is an international market, and the non-US producers can reduce their production if they feel that the prices drop too much. So a lot of moving pieces, but something I wanted to point out. So turning back over to stocks, as you know, I've been reporting the Magnificent Seven performance pretty much on a weekly basis. And for the prior week, we had 5 out of 7 performing in a positive territory. NVIDIA was down for the second week in a row, as it looks like post the 10-for-1 stock split that happened, and the index rebalancing. Does seem like investors are taking profits, capturing some of the strong performance, and just sitting on the sidelines, perhaps waiting for earnings and additional information. Microsoft was the other name that was down slightly, and the rest of the names were up. Tesla was up the highest for the week. Tesla's going to have some deliveries data announced this week, so that's something to keep an eye on. As we know, Tesla has a lot of inventory and have been forced to reduce prices recently, and we'll see if the price reduction is resulting in increased orders or not. So something to watch out for this week. I wanted to point out we had some discussions on breadth in the past. This is a chart on the S&P cap-weighted index versus the equal-weighted index. And the equal-weighted index for the S&P is just up 4%, underperforming the S&P by 11%. And that's the biggest gap in the first half of the year between the cap-weighted and equal-weighted S&P going back to 1990. So some people say that's very negative because there's a lack of breadth. But exploring some of the data further, this is some work that B of A did. Bad breath usually mean reverts, meaning that the rest of the stock should catch up, or the leaders the concentrated leaders should decline. So we'll see how that works. But the data below does tend to show that the subsequent year S&P 500 performance has been up an average of 12% with a median increase of 16.3%. So this is going back to 1986, according to this. So the averages suggest that the lack of breadth does tend to revert to the positive. So I think that's a bullish data point. Of course, that's based on past history. So you have to take this data with a grain of salt, but it does give people a little confidence that things should be revert to the positive side. A little more short term, looking at the 2-week median performance of the S&P since 1950. The first half of July has historically been the best 2-week period for the S&P 500 returns. And this data goes all the way back to 1928, according to Goldman Sachs. So hopefully history will repeat itself. First 2 weeks of July, hopefully will be extremely positive. Cool. Turning to the sector performance, energy was the leader for the week, followed by communication services. Despite interest rates backing up, real estate sector turned in the third best performance, and then followed by consumer discretionary, eking out a 10 basis point return. And this is even with the big drop in Nike, which we'll talk about a little bit later. Materials and utilities were at the bottom, and the third worst was technology. Turning to the factor performance, IPOs and recent IPOs were the best performance of the qualitative measures, followed by private equity companies that went public, and third being spinoff, which was slightly positive. Quality was the underperformer, and gurus, which are hedge fund largest holdings, were second worst performers. Small caps turned in among styles. Small caps were the best performers, probably playing catch up into the quarter end. It could be the function of a markup trade, which tends to happen at quarter ends, which we've seen a lot in the past. Momentum stocks trailed off, and high dividend stocks were the second worst performers. Turning to commodities, heating oil was up, coal was up, crude was up, and a mixed bag. We saw natural gas and ethanol being down. Brent was down. Among the metals, aluminum had a slight recovery. Gold was up slightly. The rest of the industrial metals were down. Steel down 1.38%, and copper down 1.15%. Turning to the agricultural commodities, cocoa finally gave off its huge run up. Year to date, still up 79.23, but a big drop in cocoa. So that trade seems to be unwinding. Perhaps there's an increased supply, or just huge drop in demand due to the high price of chocolate out among the retail marketplace. Sugar was up and coffee was up. And overall, it seems like the rest of the food commodities seem to be showing a drop. Rice, corn, soybeans, cattle were down, cotton was down. Lumber was also down, I think reflective of a drop in construction activity due to lower housing starts and building activity. And I mentioned Nike before. Nike just didn't do it on their earnings. Slightly inverted the swoosh there. But it looked like that was almost one of the biggest percentage drops, down 20% on Friday. So that was a very big drop for Nike. And the question is that reflective of consumer discretionary spending drops or some other exogenous factors? When I look at it, it looks like Nike has been struggling to clear inventory. There's just been a lot of discounting that they've had in their sales channels. Additionally, they seem to miss some design advancements. There's a couple of new competitors on the scene, competing against Nike, and Nike's got to make some new design wins or perhaps acquire those competitors. Hoka and On being some of those competitors that are on the scenes. And I see a lot of people wearing those shoes versus Nike. So perhaps people are getting a little tired of Nike, brand exhaustion. In any event, Nike's got to do some work on it. So looking at the economic calendar for the week, this is Monday and Tuesday, starting off the week with manufacturing data and two auctions, 3-month and 6-month. On Tuesday, we've got the Red Book. We've got a very widely watched speech by Fed Chair Powell, 9:30 a.m. Got some job openings, job quits data, and optimism, oil stock change, and logistics manager index. Wednesday is really the big day for data, and I've run through all of these, but we've got a lot of information. We've got mortgage rates, job cuts, factory orders, jobless claims, a whole host of things that runs on to a second page. This is also Wednesday again. Energy data, additional auctions, and FOMC minutes. So Wednesday is probably going to be a volatile day just before the July 4th holiday on Thursday. Turning to Friday, we have, which should probably be a quiet trading day. There's some data out there, unemployment and payrolls data, which would be pretty important. And I just want to point that out. All right. That inflation is not US inflation, sorry. The calendar showing non-US data here. On the earnings front, very light, just Constellation Brands reporting on Wednesday before the market open. So all in all, we're expecting a relatively quiet week for the start of July, with the exception of Wednesday. Maybe some volatility due to anticipated lower trading activity as people are taking off for a long weekend vacation. And that's all I have here, and I just want to point out that we're here to help our clients and financial advisors. And if any of you would like to meet or talk with Mike and myself directly, please feel free to contact Cleveland Ashley, and his information is shown here. And that's all I have for the week. And welcome everyone to July. A lot of excitement and interest in the presidential election. We'll be watching that, and we'll hopefully have some more news on that front next week, and some more discussions about what it means. For now, we're focusing on the higher probability winner now is, for better or worse, looks like Donald Trump. And we have to look at some of his policy initiatives and changes that he's talked about, which will probably be impacting various sectors and stocks. So that's some of the things we're working on and focusing now. And of course, that may change as the fundamentals and political environment changes. So we're paying close attention to it. And that's all I have for this week. Mike, anything you want to add before we sign off?
No, just happy July 4th to everyone.
Thank you, everyone. Take care.
Thank you.